Hey everyone! Welcome back to Bank and Balance, your go-to channel for all things investing and finance. Today, we're diving into something super important for anyone looking to invest: stock market indices. Whether you're a beginner or an experienced investor, understanding these indices is key to knowing where the market stands. So let's break it all down. So what exactly is a stock market index? In simple terms, it's a collection of selected stocks that represent a portion of the market. Think of it like a summary of a particular segment of the stock market. Instead of checking every stock, you can just check the index to know how a bunch of related companies are doing. Stock indices work by tracking the performance of a selected group of companies. For example, the S&P 500 includes 500 of the largest US companies, while the Dow Jones focuses on just 30, but they're all major players. On the other hand, NASDAQ tracks tech-heavy companies like Apple, Google, and Amazon. Why do we care about these indices? Well, they give us a snapshot of how the overall market or a specific sector is performing. If the S&P 500 is going up, it means most large US companies are doing well. If it's going down, well, maybe not so great. It's not just about the US here, though. There are important indices worldwide. For example, in India, we have the Nifty 50 and Sensex, which track the top companies on the National Stock Exchange and the Bombay Stock Exchange. Over in Pakistan, we have the KSE 100, which includes the top 100 companies listed on the Karachi Stock Exchange. How are these indices calculated, you ask? Well, it depends on the index. Some, like the Dow Jones, are price-weighted, meaning stocks with higher prices have more influence. Others, like the S&P 500, are market cap-weighted, meaning larger companies have a bigger impact. It's a bit technical, but the main point is that each index has a method to reflect the market as accurately as possible. Investors love stock indices because they're an easy way to track the market without needing to follow individual stocks. You can also invest in index funds or ETFs that mirror these indices, like buying a little piece of the whole market. They're great for long-term low-risk investing. Stock market indices are also great indicators of market sentiment. For example, if the Nifty 50 is climbing, it's a sign that investor confidence in India is high. Similarly, if the KSE 100 is dropping, people might be nervous about the economy in Pakistan. Now that you know the basics, you're ready to start paying attention to stock market indices and use them to guide your investment decisions. Whether you're keeping an eye on the S&P 500, Nifty 50, or KSE 100, remember, they're tools to help you, not predict the future. If you found this video helpful, hit that like button, subscribe for more awesome content, and don't forget to click the bell icon so you never miss an update. Thanks for watching Bank and Balance. See you next time with more tips on building your financial future.